Okay, hello everybody. Welcome to Karina Lanta Mentorship. And in this video, we're going to do another review of Velocity Banking and learn how to instantly create our cash flow using the concept, right? So what is Velocity Banking? All it is a debt payoff strategy using a line of credit as your main operating account. In order to do it, you only need two things. Number one, you need a budget. So you can see I have a budget right here. Income, expenses, leftover savings, and then you do an expense breakdown, and within your expense breakdown, you make sure you list every single debt that you have, and then all the other things that aren't that you just put in one giant bucket, make it easy for yourself. So um, we have that, and then number two is we need to have a line of credit. All line of credit is a tool that we either get from a credit union or a bank that will allow us to borrow money, pay it back, and use it over and over again. And lines of credit usually have higher interest rates than loans, but usually lower interest rates than credit cards, even though a credit card is technically a line of credit. And I don't know if you knew this or not, but there are over 4,000 credit unions in this country. So when people say, I can't get a line of credit, and I ask how many credit unions you hit up, they're like, zero. I'm like, okay, you, uh, I don't even know what to say to that. But I have over $279,000 in lines of credit, and here's the secret to getting it, right? Banks don't lend money to people who need it, so you got to get it when you don't need it, and that's how I have over $279,000 in lines of credit because I always got the credit when I did not need it, right? And that's the secret. So a lot of times people watch the strategies like, oh, you're in so much debt, and now's the time to get a line of credit. Oh my goodness, they rejected me, and I was like, I can't help you. Maybe some people get through the system, but as a good general principle, we want to make sure we do things right from the start with a good foundation, and make sure we get the line of credit when we don't need it. Okay, so let's just assume that we have, I don't know, a 10% home equity line of credit at $60,000 limit. So it's kind of like a $60,000 credit card, but what's really cool is that you can use it to pay anything. Now, for this the purposes of this video, I'm just going to emphasize the part about increasing our cash flow. We're not going to go through everything today just because I just want to make this easy, quick, and simple. Okay? I'm going to tell you the difference between the average American and the Velocity Banker. The average American uses their checking account as their main operating account. And that's the key word of today, main operating account. These three words. For the average American, the checking account is the main operating account. Whereas for the Velocity Banker, the line of credit is your main operating account. Okay, it doesn't mean you have to get rid of your checking account. Sometimes people ask questions like, oh, does it mean I have to do a direct deposit into my line of credit? I don't even know it's possible. I still have a checking account, but the only difference is that if we have a checking account here, it's not going to be our main operating account. And usually, we after every single month, it goes to zero, usually, right? In fact, I had a call with a banker today and says, you know what? You probably should leave a penny in there because if you don't leave a penny and it's zero for a certain amount of time, it's kind of like in a semi-delinquent status. So you might want to leave a penny in there. Okay, so let's go ahead and set up the Velocity Banking part. And so we assume two things. Number one, we have the exact same income, right? But even if you make more income, that's fantastic. But let's show the power of this with the same income. And then number two, you know how Dave Ramsey is like saying you got to save $1,000. That's the first step to create wealth and pay off debt. Well, I don't know about you, but saving $1,000 feels like it's going to take a long time, and I want results now. So we're going to have zero saving. It's the complete opposite of mainstream finance. You tell your mom, your dad this, they'll be like, "What are you talking about?" Right? What is this thing? Like you have zero savings. You got to have 3 to 6 months of savings, and it's hard to kind of, I don't want to say lecture, but convince family members that you don't need savings because our main operating account, our new savings account is that line of credit. So now what we're going to do is just copy over these debts right here, right? And then we have something called cash flow, right? Income minus expenses. Now, in the very beginning, these look exactly the same. Savings looks exactly like cash flow. What's the main difference is that we got to move some debt into our line of credit and make it the main operating account, okay? So we got 4 credit cards right here. I summed it up. How much is this? $55,000 of debt. Now, some of you are probably paying more attention than I am because you're like, hey, that's not $55,000 of debt, that's $65,000 or something like that in previous videos, but I think I added it up correctly. If not, let me know in the comments, okay? So $55,000 of debt, and again, if we have enough room in that line of credit, let's just move this $55,000 here. And here's the crazy part, right? Actually, before I even start this, I'm going to tell you where most people screw up. If you ever go on Reddit and look up posts about like people struggling in their HELOC, do you know why they struggle? It's because they have a savings account, right? When you have a savings account, you're not making your line of credit as your main operating account. Every single post on Reddit where I said I'm struggling with the HELOC, they always say something ridiculous like I got 20 grand in savings. I don't know why I'm struggling with the HELOC. It's kind of the opposite of what you think would happen, right? But we're going to go ahead and show you the difference between doing this and this right now. So some people think, oh, if I had a line of credit, I could do this, right? So let's say you had $1,000 emergency. Okay, $1,000 emergency, and a car broke down, and you need to go to a repair shop. It probably costs more than $1,000, but let's just say we had $1,000 emergency, and the minimum payment on your home equity line of credit is $50. Okay, well, guess what happens right here? Now we got an extra $50 payment, and now, whoopsie, I probably screwed up. Plus $50, my bad. Plus 50, and now we got negative savings. The banks will want us here because I don't know if you knew this or not, that overdraft fees are a big money maker for banks. In fact, last year they made over $5 billion. And what's funny is that that's actually a lot less than they used to make because of, I think, bank reforms or something like that. I don't know. Like, we live in a crazy world where the banks are like, we're not going to be as greedy in 2023 and make a lot less money, and that lot less money on overdraft fees is $5 billion. So look at what happens when we borrow money from our line of credit and not make this our main operating account. We're in negative territory, right? So no bueno. Let's not do that, okay? So what we're gonna do is we move this credit card debt, right? All this credit card debt, $55,000 right here, okay? And guess what happens just by simply transferring this debt and making this into our main operating account? What happens? Well, all of these payments just simply go to zero. Zero, 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 zero. Oh my goodness. So we went from $23 and increased our cash flow on day one without making more money to 1800. Can you believe that? Let me go ahead and zoom in so you can see dramatically the dramatic effect of going from $23 to $1,800, right? And you wonder, right? You wonder why this feels so attractive. Why is it that the whole world is teaching about this, and then when you see this velocity banking, you're thinking, ooh, why didn't anybody tell me about that? That's what I wonder when I first learned this concept too, right? So let's go back here. Oh, not this sheet, this different one, where we went literally on the struggle bus from here with that much expenses, with $23 left over in savings, feeling like a failure, with zero savings to $1,800 in cash flows. Isn't that crazy? Simply by making our line of credit as our main operating account. Okay? And what's the actual strategy is your entire paycheck goes into the line of credit and then expenses out of the line of credit. Your expenses come out. So the moment that you get paid, it doesn't matter whether you get paid weekly, bi-weekly, whatever. You put your entire $5,000 in here, whatever you get paid for the month, and then this turns to $50,000. And so when we put our entire paycheck, there's two main benefits. Number one, it satisfies the minimum monthly payment, so that payment doesn't matter anymore. Number two, it minimizes the interest because the interest is calculated by the average daily balance. So when we put our full power of that paycheck, we don't pay as much interest, right? And then so now 5,000 here, and then it's going to go up by 3,199, so 3,199, and then oopsie, I screwed up. 3,199, and then you just rinse and repeat over and over again. Now, does this mean you have to get rid of your credit cards? No, you don't have to get rid of your credit cards. What we do is once we've transferred that debt and made our line of credit as our main operating account, we only use our credit cards up to this general expense limit, right? And the beauty of using the credit cards, okay, is that credit cards have an advantage that lines of credit, regular lines of credit don't, like personal or home equity. when you pay it off in full, you don't pay any interest and you can accrue some bonus points. So as you're doing the strategy, you might still want to use your credit cards, but only up to your budget of about $2,000 for your non-debt expenses, food, gas, insurance, and then you just pay it off as late as possible, so you could possibly delay the interest on what you have normally paid from the line of credit. Okay, so let's go ahead and calculate this 0, and then calculate the next month. So I2 plus 1. And then what we got to do is just make a mathematical formula of calculating the next month's balance, which is the previous month's balance plus the previous month's interest, minus this cash flow number, 1800.9. So right here, we're on the struggle bus. We're not at $23 anymore. We're at $1,800. And then let's go ahead and calculate the average daily balance right here. And then we get the average function to estimate that average daily balance, multiply by the interest rate, which is 0.1, 10%, and then divide by 12. Okay, so now let's go ahead and copy these numbers, okay? And it's probably going to take us about 2 years or so. Well, let's see how long it takes us, or maybe 3, I don't know. I mean, we were at near zero cash flow, right? So let's go ahead and see how long it took us. 36 months. Oh, it's 3 years. Okay, so 3 years to get rid of that negative cash flow, and as we're working to get rid of that, I will. What am I saying? As we're working to get rid of that negative cash flow, and we spend our time to increase our income during those 3 years, right? I think a lot of people have this mindset. It's like, I can't make more income. You certainly can. Um, there's a lot about, limiting beliefs that people have. So don't be afraid to try to make more income. But what I'm saying is that we have a lot more breathing room right now. So let's see what happens, okay? If we have a $1,000 emergency, and if this stays the same, if this increases, okay. So we saw that when we did the average American scenario, and we had $1,000 emergency. Oh my goodness, we were screwed, right? Because we got that negative savings and overdraft fees, and they might report us to check systems and snitch us out to other banks when we try to get a new checking account. I don't know if you know that the banks have their own reporting system when screw up with checking accounts, just like they got the credit bureaus for when you screw up with loans and credit cards. All right, so now let's go ahead and do 56 and see how long it takes us to pay this off. And it takes us the exact same amount of time to pay off that debt. Isn't that crazy? 36 months. So literally, the $1,000 emergency did not affect our debt payoff. Not at all. Not even by a month, right? So now let's just write this quick milestone right here. So 36 months, and how much in debt? It is 56K, and then right here and right here. And so now we paid off these 4 credit cards. And yeah, that's the power of increasing your cash flow immediately with the help of a line of credit on day one. I probably need to do a more in-depth video about paying amortized loans, because here's the thing: you see on the internet, oh, just replace your mortgage with a line of credit, and in my opinion, that's probably not a good idea. Like first lien HELOCs. To replace a mortgage, like if your mortgage is 2.85% and you replace the whole thing with a 9% home equity line of credit, you probably will pay it off faster than normally, but there's ways where you could even pay it off faster without having the same issues that you would have using extra payments, right? So we'll go over that in another video, but the whole point of this video is that number one, we want to show the difference between the average American velocity banking is. So some people are like, oh, I just get a line of credit and it'll work out for me. No, no, no. It's your line of credit as your main operating account, because when we had that $1,000 emergency, they weren't that negative territory here, right? But when we had the $1,000 emergency, when we made our line of credit as our main operating account, we still had the same payoff and we had no cash flow issues, right? We were okay. 36 months to pay off at 56,000. So just another video for today with Velocity Banking, learning how to increase our cash flow in an instant. Again, if you need a line of credit, always get it when you don't need it, because banks don't lend money to people who need it. And I learned this from a business credit coach. I don't know what's I guess I shouldn't say coach, instructor, a long time ago from Renatus. I don't think she teaches the course anymore, but that was the thing that I remember for her. When I first learned about business credit for her, she was like, oh yeah, I made the most amount of loans in, I don't know if one of the big banks, right? or she was like the #1 loan or credit issuer, really smart. And she was like, banks don't lend money to people you need. And she kept emphasizing that. I was like, what are you talking about? Nobody's ever taught me this. And then that's how I have over $279,000 of credit. I'll probably be over $600,000 soon. I'll let you all know once I get there, but we'll see if we get there. All right. Well, have a great day, everybody. Another quick Velocity Banking review. This is Crane Atlanta Mentorship. Good night.